All right, hopefully the recording works. Let's start with topic 10 today on capital budgeting, NPV, and capital decision. So before I start, let me tell you on making decisions. All right, there are 4 things to know for making decisions. Okay, project evaluation. So we're talking about project evaluation. All right, and this project evaluation, there are 4 methods. Number 1, NPV. Number 2, IRR. Number 3, payback period. And number 4 is AAR. Okay, so NPV is the short form for net present value. IRR, in turn, rate of return. Payback period is time when you get back your payment. AAR, if average, okay, average accounting. Anyone knows? AR, anyone knows or not? Don't have, forgot. Yes, very good. Average accounting return. Okay, so take notes. This is the 4 methods to evaluate a project, whether when to do it or not. So the problem here, 1 and 2 is the one that determine decision maker. 3 and 4 is just giving you an idea. Okay, what does it mean by NPV and IRR is decision maker, but payback period and AR is an idea. So payback period and AAR is not so accurate to evaluate whether a project worth doing it or not. It's just a rough one. Okay, you just use it easily to just calculate. Okay, roughly, this is a positive one, so we could accept this. But to evaluate further, you need to use NPV and IRR to make the decision whether should you invest in this project or not, or will this project give you returns or not. Okay, so keep this in mind. There are 4 methods for project evaluation. Only NPV and IRR could be a decision maker, whereas payback and AAR are just a rough figure or a rough estimation of whether this investment worth it or not to be invested in. All right. Okay. So this is the 4 things for as project evaluation, and recapping it, simplifying or making it a summary to you. So let's see on the first question now what they are asking you. Okay. Let's go to the questions now. So can all seen this? All right. Have an idea now. Keep it in mind. Let's move on. I can't drag too long because they are quite lengthy, today's tutorial. So let's look at the first question here. Klemner Manufacturing imposes a payback cutoff of 3 years for its international investment project. All right. If the company has the following 2 projects, should it accept either of them? Calculate the NPV of the project if the required rate of return is 10%. Which project should we accept if both projects are mutually exclusive and independent? So there are so many parts of the question. Okay, so many plus. So the first section, let's look at the figures that they give us first. Year 0, 1, 2, 3, and 4. Then you got cash flow A, means project A, and cash flow B. So cash flow A started with negative $45,000. This is the initial investment. 17K return on year 1, 23K on year 2, 19,000 on year 3, and 100,000 in year 4. Cash flow B started with negative 90,000. Then move on to 19,000 as cash flow in year 1, 24,000 in year 2, 35,000 in year 3, and 55,000 in the final year. So this is the information given to you in the question. Okay, so let's look at the first thing, what the question is asking us about. They want to impose a payback cutoff of 3 years for international. So this company is looking at 3 years to see whether is it worth it or not. Okay, so if the company has the following 2 projects, should they accept either of them? So the first part of the question is cut off at 3 years. Okay, cut off at 3 years. So when the question says cut off at 3 years, this means they use the project evaluation method of payback period. Okay, so payback period of A and payback period of B. So this is what you need to count. So what does it mean by payback period? All right, so very simple. Basically, payback period is initial investment. All right, initial investment is 45K. Okay, so in 3 years time, can you get back your money or not? All right, so year 1 you get 17,000. Year 2 you get 23,000. So definitely year 1, year 2 complete already, getting 23,000 is still 30K only. It's 30,000 only. Okay, it's 30,000. So period A, you need 2 years plus how many months? So third year, you're supposed to get 19,000 out of 45K. All right, so 17 plus 23 is 30K. Your initial investment is 45,000. So 45,000 minus 30,000, you still need to get the return of 15K. So in year 3, oh yeah, sorry, 40K. Thank you. Sorry, still have some miscalculation. So it's 40,000. 23 plus 70 is 40,000. So you got balance of 5,000. So that means in year 3, you don't need to take a whole year to receive 19K to recover your payback. Halfway through, you already get it back. So in other words, it's 5,000 divided by 19,000. So 2,000, so 2, right? Year 1, year 2, year 3 is only a portion of it, which is 5,000 divided by 19K. So this will be total up into 2.26. So your 2 payback period for cash flow A is 2.26 years. Okay. As for cash flow B, initial investment is 90,000. All right. Year 1, again 90,000 minus 19,000 is 71K balance. 71K balance minus 24K. So it's 47K, negative 47,000. 47,000, year 3, 35,000. Okay, 47 minus 35 is still got negative 12,000. All right, so that means this one take 3 years plus. Okay, so got balance 12K some more. So 12K divided by 55,000. Okay, so this will get 3.22 years. Okay, this is how you count your payback period. Cannot? Is it hard or easy? Okay, so it's quite easy to count the payback period. It's not hard at all. It's very straightforward. All right, you just make sure to deduct the cash flow and see where you stop. Okay, this is very easy, the easiest among the 4. Why we don't take the value of the 4th year for project A? Because you already want to count when is your payback period. When do you get back your 45,000? That's all. Okay, so when you talk about payback period, you only want to see when do you get back your initial investment. So you stop at 3rd year. Okay, you stop at there. All right. So for cash flow A, the initial investment is 45,000. You take 2.26 years to recover back that money. Whereas for payback period B, which is cash flow for B, your initial investment is 90,000. So you take 3.22 years to recover back your initial investment. So if the company tell you the cutoff is 3 years, okay, so which project should you accept? All right, when they say cutoff 3 years means the company looking at they wanted project which get back their money in less than 3 years. So Dingy says payback period A. Yep. Project A. Yes. So the only project that you accept is project A because it only takes 2.26 years. But payback by cash flow B, it takes 3.22 years. It's exceeded the timing of the company. So you don't accept it. Okay. This is the criteria on accepting payback period. If they tell you cutoff is 3 years, then you must look. Anything exceeded 3 years, you will not accept. But if let's say you change the cutoff to 4 years, then you can accept both. All right. Okay. So that is the first part of the question. All right. Second part of the question, they're telling you calculate the NPV of the project. If the required return is 10%, which project should we accept if both projects are mutually exclusive and when it's both independent? So second part of it, we talk about the all right. The second one, they want you to count NPV, net present value. So net present value, what is the formula? So I write out the formula for you. Okay. Net present value, the formula is basically like that. C0 is the initial investment. All right. Plus the sum of cash flow from year 1 onwards divided by 1 plus R of T. Okay. All right. This is the NPV formula. All right. So NPV is very simple actually. All right. NPV formula is like this. So it might look a bit complicated. So you just make sure the starting one is always negative because that's the initial investment. Then after that, you plus with the cash flow discounted by 1 plus R power of T. So they're given to you the interest rate for this question. They tell you the required rate of return, okay, is 10%. So your IY is 10%. Okay, the IY is 10%. So when you count net present value, if you put it into a table or in a graph, we look at NPVA first. Okay, NPVA. We go slow a bit, but make sure that you guys could understand it well. So NPVA, just know the cash flow, there are 4 cash flows, 0, 1, 2, 3, and 4. Not nicely marginalized. 1, 2, 3, and 4. Okay, so the first year, how much is the cash flow? Let's look back. 17K, 23,000, 19,000, and 100,000. Okay, 100,000. So here is year 0. You want to count NPV. NPV means here. What is NPV? Okay, so this year 1, year 2, year 3, year 4. IY 10% means 0.1. So what does it mean by net present value? So C0, this is the initial cash flow. Okay, so this is an initial investment. So this will be negative 45,000. Then you want to count all this cash flow discounted backwards to times 0. All this will be discounted back to times 0. So how do you do that? So NPVA, NPVA will be equals to initial cash flow of negative $45,000 plus cash flow at year 1, 17,000 divided by 1 plus R, it means 1 plus 0.1, power of 1, discounted one time. Okay? Then 23,000, 1 plus R, discounted 2 times because 2 years. 19,000, 1 plus R, discounted by 3 times, 3 years, 1, 2, 3. And lastly, 100,000 divided by 1 plus R, power of 4. Okay? This is how you count net present value. This is basically net present value. So with this, negative 45,000 plus this, plus this, plus this, plus this, what do you get? Is this a positive, positive one or a negative figure? Okay? Is it a positive NPV or negative NPV? All right. So you calculate this. Okay? You calculate this. So in the end, by right, I give you the answer here. Yes. Stephanie already got it. Yingyi also got it. $72,039.14. Okay? Your net present value is $72,039.14. Okay? This is a positive figure. All right. Repeat this for NPVB. Okay? Before I move on to NPVB, you could use the financial calculator to count NPV actually. All right? But it's very complicated. Okay? Let me show you the calculator way. I'll draw it in yellow. So what you need to do is, you need to click cash flow first. Cash flow. Second, clear work. Okay, NPVB, you got 10,969 and 18 cents. All right, okay, never mind. So never mind, I'll teach you the calculator way first. I show you first. Click CF, second clear work. All right, then click CF0. You see a CF0. You enter. You click in 45,000. Put plus minus. Then you click enter. Okay. After that, click down. Click down. You will see C01. C01. You put in $17,000. Then you click enter. Okay. Then you click arrow down 2 times. You see C02. If you click 1 time, you see F011. So don't care about F. So click 2 times to see C02 again. C02, you input 23K. Then you click enter. After clicking the figure, must always click enter. If not, it will not save into the system. Then click 2 times again to see C03. Okay. You key in 19,000 and then enter. Lastly, click 2 more times for C04. You key in 100K. Then you click enter. Okay, then you click enter. So after that, all right, after you enter the C04, okay, you click on NPV. All right, you click on NPV. You click NPV. Okay, then when you click NPV, you see interest. You key in 10 and then you put enter. This is the interest rate. All right, you press down 1 time, you compute your NPV. Then you should get this 72,039 ringgit and 14 cents. I think calculator will just give you this. Same thing. Okay, so you can try this calculator method. So it's important, it's easy for NPV to use the manual way straight away actually. All right, but you need to know this calculation, this exact calculation, because you use this to count your IRR. I will show you later on. So take note of this, keep this, okay? Practice this later. All right, I won't spend too much time here because we got a shortage of time. Okay, so let's move on to B. So NPV B, a lot of you already attempted it. All right, a lot of you already attempted NPV B. So NPV B started off with negative 90K, okay, the manual way, yeah, plus with 19,000, 1.1 power of 1, okay, plus this is I'm writing this out for those who couldn't get it. 24,000 divided by 1.1 power of 2, 35,000, 1.1 power of 3, and the last one is 55,000, 1.1 power of 4. So this will give you 10969.2. Okay, same thing for the calculator. You just change the cash flow. Plus minus 90,000, 19,000. Okay, 24K, 34K, 55K. Interest is 10%. Enter, compute your NPV for B. You get a 10,969.2. So now the question still not ended here. NPV B is 10,969.2. All right, whereas NPV A, why is it times by 1, not 0.1? Where's the times by 1? Where? What are you talking about? Where is it? Here, 1.1 is 1 plus 0.1, so it's 1.11. Okay, this is to count present value formula. PV equal to FV divided by 1 plus R, what? Power of T. So NPV, you're counting backwards. You're counting the present value. So this is basically present value, but for multiple cash flow. So I don't understand what do you mean by times by 1. I don't see any times by 1. Please clarify your questions. The R, sir. Yeah, the R is 1 plus 0.11. PV is equals to FV divided by 1 plus R power of T. So it's 1 plus 0.1. Yeah. Okay. All right. Okay. So NPV is 10,969.2. NPVA, just now we find is 72,032,39.14. Okay. So these two, the question asks you here, look at it. If they ask you if both are mutually exclusive, what should you do? So remember this, students. Yes, very good. If the question tell you mutually exclusive, this means choose the best one. Choose the best. So in this case, NPVA is the best. Why? Higher return. Okay? All right. Second one, if they ask you if both projects are independent. If both projects are independent, what do? You choose both. Why? Why choose both? Because how to evaluate NPV? As long as NPV is more than 0, you accept. This is in your lecture slides, so you can go revise it. For NPV, as long as it's more than 0, that means it's a positive NPV, you accept. That means you already earn money. Right? So if they tell you it's independent, that means it's not affecting. You can choose all the projects that's available. So in this case, both is positive, so you can accept both. But if they tell you it's mutually exclusive, means choose the best investment. So when you call you to choose the best investment, you choose the one with the highest investment return. Clear? All of you, are you all okay? What to do if NPV is 0? NPV is 0, then you don't invest already. NPV is 0 is break even lah. So NPV 0 is break even. Okay, so you can choose whether you want to invest or not. Okay, but you can actually accept it also with NPV if less than or equal to 0 because you already got expected return. All right, you got expected return of 10%. So if NPV equals to 0, that means your return is only 10% lah. So you can still accept it. Okay, so criteria for NPV is equal to or more than 0 lah. So equal also can accept because you already got internal return of 10%. So regardless of what happened, you still earn 10% return rate. Okay? Can I ask Stephanie? All right, good. Very good. So let's move on. Let's move on to the second evaluation method. All right. So we will go to second evaluation method. This method is called AAR. Okay, AAR. So you are trying to, let's go to the question together. Then we write down what is important. You are trying to determine whether or not to expand your business by building a new manufacturing plant. The plant has an installation cost of $17 million. Right now, important information. Installation cost of $17 million. By the way, students, just now the previous question, right, is a very favorable question in exam. Okay, they will ask you the payback period and the NPV at the same time because they can share the same cash flow. All right, that is something that the exam would like to ask. In exam, they like to ask you lah. That's a favorable one. So this semester, to take note whether it will be questioned or not. So look at the tips or hints from your lecturer. Okay, so this one AAR, installation cost $17 million, which will be depreciated straight line to 0 over its 4 years life. If the plant has projected net income of 1735 million, 2105 million, 1945 million, and 1342 million. Year 1, year 2, year 3, and year 4. Okay, so each year they give you different cash flow. Then they call you to count the AAR straight away. All right, then they call you to count the AAR straight away. So this question very straight to the point. They want you to find average accounting return. So AAR formula is this: average net income divided by average book value. All right, average net income plus average book value. So look carefully at this question. So in this case, they already tell you the net income. All right, never tell you anything about book value. Later we talk about book value. So start off with counting the average net income. So average, you know lah, net income. Basically, you total this lump sum divided by 4. So 1735 million plus 2105 million plus 1945 million plus 1342. No space. Million. Whole thing divided by 4. What is the average net income? Okay, you should be getting yes, ID already got it. 1,781,750. Average net income. Part 2, average book value. So this part 2 is the one that students always make a mistake here. Student always get marks here. And this question always come out in the receipt exam. Always come out in receipt exam. So I don't know whether you will come out in the final exam this year or not. Okay, or this semester. So we will see. Okay. So average book value is the one that students always make the wrong mistake. So average book value is basically initial book value plus the salvage value divided by 2. Okay? So in other words, the initial cost, all right, read back the question, the initial cost is 17 million. Okay, initial cost is 17 million. What is the salvage value? Straight line depreciation to 0. So salvage value is 0. So 17,000 plus 0 divided by 2. Must always divided by 2 because it's two different value. Although this 0 is still talking about two different value. So must divide by 2. Okay, the mistake that students always do, they don't divide by 2 because they assume this is 0, so not counted. So no. So book value, average book value is must always the initial value plus the salvage value divided by 2. If the question will give you salvage value, then you need to put the value. If no, it's 0. Because in this question, they say depreciated to 0. So your average book value here is actually 8.5 million. Now you got average net income and average book value. You can do your AAR already. So AAR is equal 1,781,750 divided by 8.5 million. So what do you get? 0.2096 or 20.96. Very good, Sula. Okay, 20.96. All right. So this question, all right, AAR, they should give you the cutoff rate. Okay, but this question, they never give you any cutoff rate. So assuming cutoff rate is 25% lah, all right, assuming cutoff rate is 25%, if cutoff is 25%, yes, you reject because 20.96 is less than 25%. So you reject. So look at the question. Look at question carefully. If question never tell you the cutoff rate, then you're assuming that this is over 4 years. Okay, this is over 4 years. So 100 divided by 4, so it should be 25% per year. Okay, so this is how you get the cutoff rate. If the question never give you lah. All right, if they tell you, they'll usually tell you the cutoff rate is 10% or 15%. Then you compare with your AAR. So if your AAR is more than that, you accept. If less than that, you reject. Simple. AAR is basically like that. Okay? Ken, are you okay? All right. So please, hopefully you all can look back at the video later because I think it's already recording. It could be uploaded on YouTube later. So watch it over and over again to practice it because we need to go through very fast. Okay, we're still very far behind. All right. So now we already did 3: AAR, payback period, NPV. So we are left with the last method, which is something not very favorable among students. Okay, the last method is IRR. IRR is very similar to NPV. Look at 8.5. A firm evaluates all of its project by applying the IRR rule. If the required rate of return is 13%, should the firm accept the following project? Okay, so in other words, they're telling you the firm are setting a 13% IRR, a 13% required rate. You want to find the IRR, is it 13% or more or not? Okay. So it's a bit confusing. IRR itself is an interest rate. Now they already tell you the required return is 13%. Okay, so what they're telling you, the company wants 13%. So you need to calculate your cash flow. Is your IRR more than or equals to 13% or not? That is a motion. There's a motive here. Okay, that's a motive here. All right, so this one aside, let's throw out the question. Year 0, 1, 2, 3. The cash flow negative 4550, 1750, 2550, and 540. Okay, these are the things they give it to you. All right. So what is this IRR? Simple, huh? The assumption of IRR is, remember this, IRR is assuming that NPV is 0. Okay, IRR is assuming NPV is 0. So you use back the Npv formula. You use back this Npv formula. Okay, so basically to count IRR, you equate the whole equation equals to 0. So NPV is equal to 0. 0 equals to initial investment of negative 4550 plus 1750 discounted by 1 plus R, right? 1 plus R. This R is IRR. Power of 1 plus 2550 divided by 1 plus IRR, power of 2, and 540 divided by 1 plus IRR, power of 3. This is the equation to count IRR. So if I draw it in a timeline, just to make sure that you can see clearly, if it's in the timeline 0, 1, 2, 3, 1750, 2550, and 540. So basically, you want to find NPV equals to 0. You need to discount all this backwards. Here, NPV equals 0. So the thing missing here is the IY. This IY is your IRR. Okay? So when you see this kind of situation, you know you need to use the try and error method. So those without a financial calculator, you will have a hard time finding IRR. You need to fill in the blank one by one until you get the total of all this is equals to 0. So you use try and error. Okay? Try and error. Try and error. Okay? But those with a financial calculator, life become easier. So you do exactly like what we did just now for the NPV question. Okay? For the NPV question, what do you do just now? The first thing first, you click CF. Second, clear work. You must clear your work first. If not, they will record the previous cash flow inside your system. So you clear already, you see your CF0. All right, CF0 means your initial cash flow equals, put in the plus minus sign of 455. Put in the plus minus sign of 4550. All right, initial investment, enter. Click down one time, you will see your C01. Put in the first cash flow, 1750. Remember to click enter. Enter 2 times, C02 equals to 2550. Enter. 2 times C03, 540. Enter. Okay, enter. Then click on IRR. Compute. When you see IRR, you compute, you get 3.613 away. No need to click to NPV. So you click IRR, compute, then you can get your IRR. So this is the calculator method. Try with the calculator method until you get this figure. Practice it yourself. Okay? Practice it yourself. I couldn't babysit one by one already. So now it's already nearing the end. Yes, you reject. Why? Because 3.61 is less than the expected return. If it's AAR, if it's equals to all of this, if it's equals to, you can still accept one. Okay? Equals to or more than, you can accept, no worries. F01, you don't key in anything. You don't key in anything, you just skip it. You click arrow 2 times. Okay? Don't key in anything into F01. All right? So in your calculator, you skip the F01. You don't click in anything. Just click in C01, 1750. You click enter. That's why I call you to click arrow 2 times. You see C02. Then you get 2450. Then you click enter. All right. Then you go down some more. You get C03. Then you key in 540. You enter. Then click on IRR and compute. All right. So anything. Okay, just now we already go through 4 of it. Number 1, payback period. Number 2, NPV. Yes, exactly. So IRR is actually how much you will get. IRR means the interest that you're actually earning if NPV equals to 0. Okay, so if this project, the net present value is break even at 0, what is my return? So in this project, the return is 3.61 only. Okay, but the company is expecting it to have 13%. So this is definitely not what the company wants. So they will reject this investment. Get it? Okay, good. NPV, AAR, and last one is IRR. So all this, as long as it's more than or equal, then you will accept or reject. Okay, so payback period, it depends on the cutoff. If it's more than a cutoff, reject. If it's less than or equals to the cutoff, you accept. Okay, NPV, as long as it's more than or equals to 0, you accept. AAR, as long as it's more than, okay, or equals to the cutoff, you accept. IRR, as long as it's more than or equals than the required return, okay, the required return, you accept. This is the benchmark. This is cut off. Okay? Can? So I already summarized it. This is the benchmark for all 4. So go and practice it. Go and find out. Okay? So we move on to following questions. We still got a number of questions to go. All right? And we only have left around 1 hour. So let's move on. Okay? We're not wasting more time. Let's move on. Part 2 of the capital decision. So let's look at this. When evaluating projects, 9.5, when evaluating projects, we are only concerned with the relevant incremental after-tax cash flow. Therefore, because depreciation is a non-cash expense, we should ignore its effect when evaluating project. Critically evaluate this statement. So they're telling you, when you evaluate project, right, we only care about those that are those incremental after-tax cash flow. That means those affecting your cash flow. All right. So this statement telling you depreciation is a non-cash expense. That means depreciation you cannot see. Okay, it's an expenses that you didn't spend it. It's just depreciated on your asset. So something that you cannot see. So we should ignore its effects when evaluating project. So they're telling you you should ignore depreciation. So the answer to this is very simple. Yes, depreciation is non-cash, but the problem is depreciation is tax deductible. Okay, tax deductible. So because it's tax deductible, that means it's affecting the cash flow. All right, so you cannot ignore depreciation. Okay, so you cannot ignore depreciation. So this question, they will give you the solution. Your lecturer will give you a solution. It's a very lengthy one, it's textbook answer. So you just answer that. You just go and remember that or go and read it to understand it. So basically it's simple. So this statement says depreciation is not important because it's a non-cash expense. So it's wrong. This statement is wrong because although depreciation is a non-cash expense, but depreciation is affected because of tax deductible. So when there's tax deductible, there is a depreciation tax shield, which could affect the cash flow. Okay? So as long as it's affecting the cash flow, although it's a non-cash expense, it's still important to be taken into consideration. Okay, that's what it means. Simple. It might sound confusing to you, okay? I simplify it a bit for you, at least you can see.
This don't break my heart.
Depreciation is a non-cash expense. All right, but depreciation is tax deductible. So when it's tax deductible, okay, tax deductible will create a depreciation tax shield. All right, it's not a non-cash expense, okay, but it's tax deductible, and this tax deductible will contribute to a depreciation tax shield, and this tax shield will reduce, okay, or affect your cash flow. So this sufficient enough to say that depreciation is important to take into consideration of your income statement. Okay? Or take into consideration of evaluation of the project. All right, this is a simplified one. So when you receive the solution, read through the long one and understand it according to this chart that I draw it to you. Okay? So I won't waste too much time on the theory. So we move on. We move on to 9.2. All right. 9.2 is a very interesting question. But students get confused over it. So let me tell you the story here. So Chinko Limited currently sells, this is the information, currently sells 28,000 motorhomes. Okay, at how much? 73,000 each. And 7,000 luxury motor per year at 115,000 each. The company wants to introduce a new portable camper to fill out its product line. It hopes to sell 23,000 of this camper per year at 19,000 each. Okay, so now the company want to introduce, this is their yearly sales. So now new product. Okay, 23,000 they want to sell. Call camper, and each of them is 19,000 only each. So a consultant has determined that if Chinko introduced a new camper, it should boost the sales of its existing motorhomes by 2,600 units per year. Okay, So with this new product, they can sell 23,000 camper and 19,000 each. Okay, then expert review with this new product, it will affect the previous sales. So there will be increase of 2,600 unit of motorhomes. Okay, but the problem, it will affect the sales of the luxury motor. So negative 950 sales. Sorry, 850. Negative 850 units of luxury motors. What is the amount to use as the annual sales figure when evaluating this project and why? Okay. Look at this, guys. So this is the previous sales. Now, company introduced new product already. This new product estimated could be sold 23,000 unit, 19,000 each. Okay. At the same time, on top of these yearly sales, this new product introduced already, it will increase motorhomes by another extra of 2,600 unit. So each unit is sold at 73,000 each. Okay. Yes, although there's an increment of motorhomes, but there's also a decrease in the sales of luxury motor by 850 unit. So this one is 115,000 each. Okay. So you look at the new product here. New product has a buy effect. New product can get sales, but at the same time, it will affect the previous sales. So now we're going to evaluate, is it worth it or not for this new product to be introduced? All right. So these are the outcome. So first of all, you want to count how much of sales of this camper. So you count camper sales first. Camper sales, 23,000 units multiplied by 19,000 each. Okay, you get $437 million. All right. Okay. Then count your motorhomes. Motorhome increase of sales, 2,600 by times 73,000. How much they give you? 189 million, 0.8. 189,800,000. Lastly, this is luxury motor. Luxury motor lose money. Okay, lose money. So negative, decrease unit. Put a negative there. Times 115,000. So it got a negative losses. So losses are negative 97,750,000. Okay. Question 5 asks you to find what is the net sales of this project. All right, what is the net sales? So the net sales means total all this up together only. All right, hold on. Hello. Yep. All right. So net sales, So net sales, Stephanie already got it. So net sales is basically the camper sales of 437 million plus 189,800 minus 97,750,000. So this will give you 529,050,000. Okay. So this is a good investment. Why? Okay. Why? Although after introducing this new product, this is the extra sales that you make. Although there's a reduction on luxury motor, so it's still worth it. It's still worth it. On top of the previous sales, again of this much. Now with this new product, you got this extra of $529 million. Okay, that's what it means. All right. So some students will make some silly mistake here. They say, sir, before that is 28,000 motorhomes, now extra 2,600 one. So it should be 30,600. No, you don't total up with the yearly sales. This one is just a benchmark here in the previous years. So now with the new product, extra new sales and decrease of these old sales. Some product sell more, some product sell lesser because of this new product now. So you want to see, will this new product be a positive impact or not? If this new product cannot give you any earning and then they make you more losses, after deducting, you still get a negative figure, that means it's not worth investing. So in this case, you still get a positive figure. So it's worth it. It's worth it to introduce this product. Can are you okay? Can follow? Okay, all right. Can we go? Can we go? Okay, this next following question is very simple. It's basically an income statement. So this is something that you already did a lot of time. It's repetitive. So they tell you sales, variable cost, depreciation. $52,000, $39,500, $76,000. They want you to find the EBIT, the taxes at 35%, and the net income. Fill in the missing number and calculate the OCF. What is the depreciation tax shield? So this is the figure that they give you in the income statement. They want you to find two things. Number one, they want you to find OCF. So I think you still remember your OCF, the formula is EBIT, okay, plus depreciation minus taxes. The second thing I want you to find is the depreciation tax shield. Okay, depreciation tax shield. So basically, is depreciation times with tax. Simple. All right. So this question is simple. They give you an income statement. They want you to find OCF and the depreciation tax shield. So what you do, you complete your diagram first lah. So 62,000 minus 39,000 minus 76,000. What do you get for EBIT? Okay, the EBIT is negative 53,500. Yep, very good. Negative 53,500. So if you're negative 53,500, is there any taxes or not? If a company not making any money, you're making losses, do you still get tax or not? No tax, right? So tax is zero. Okay, so net income and your net loss is 53,500. Okay, simple, very easy income statement. So to count the OCF, your EBIT is negative 53,500 plus your depreciation just now is 76,000 minus taxes is zero. Okay, so your OCF that you get is 22,500. Yeah, very easy. Then depreciation tax shield. Depreciation is 76,000. Your tax is 35%. So your depreciation tax shield is 26,600. Very easy. Okay, so just need to remember the formula for OCF is EBIT plus depreciation minus taxes. Depreciation tax shield is depreciation multiplied by tax only. So the depreciation tax shield is 26,600. Why isn't tax 0? Because this is the tax rate 35%. It's not this taxes amount. It's two different things. Okay? So the formula for depreciation tax shield is depreciation times the tax rate. But OCF is the tax amount. All right, now. So this is tax rate, not tax need. Okay, very simple. All right, let's come to the final section, which is the most complicated section. It's called the project evaluation section. Okay, some examiner or some module leader like to put this into your final exam. Some they will exclude it out. All right, because it's too challenging. So I don't know. You just see what is the tips given by your module leader. See whether you come out or not. All right. So a lot of information here. I will show you once. Hopefully you can follow. Okay. So look at this. This is a project evaluation. Agro Food is looking at a new sausage system with an install cost of $625,000. Install cost $625,000. This cost will be depreciated straight line to 0 over the project 5 years life, at the end of which the sausage can be scrapped off for $95,000. So this one got a salvage value, $95,000. The sausage system will save the firm $183,000 per year in pre-tax operating costs. Pre-tax operating costs per year, you save $183,000. Okay, and the system requires an initial investment of net working capital, NWC, net working capital of $41,000. So if the tax is 34% and the discount rate is 8%, what is the NPV of this project? These are the information given to you. So what should we do now? All right. So count NPV. That means you need to get the operating cash flow. Okay. To count NPV, you need to get the operating cash flow. So what happened here is that this. Year 0, year 1 to 4, year 5. Okay, because this project will be depreciated straight line for 5 years. So you want to count is the investment on this sausage system value or not. Okay, initial investment $625,000 for 5 years to be depreciated to 0. You want to count is this project value or not. All right. Okay. Oops. So to see value or not, let me draw the straight line to separate it. Oops. Okay. So there are a lot of criteria here. So first of all, first thing is the system cost. So this system cost you $625,000. So I put a bracket there to indicate money go out. Okay, money go out is put into a bracket, indicate money outflow. System cost you $625,000. Second thing to talk about is the depreciation tax shield. Okay, depreciation tax shield. So the depreciation tax shield, the formula just now I already showed you, depreciation times with tax. So in this case, you want to count. This project is $625,000, but then it depreciated straight line to 0 after 5 years. So this amount multiplied by the tax rate of 34%. All right. So what is the depreciation? Okay. What is the depreciation tax shield for each year? 42,500. So year 0, no depreciation. Year 1 to 4, every year you will have a protection of 42,500. Tax shield, so this is not outflow. It protects you, reduce your cash outflow. Okay. Moving on to the second thing. Moving on some more. The salvage value. You know there's a salvage value for this. So you need to count the after tax salvage value. Okay. So just now the salvage value, this is the formula, minus tax times salvage value minus book value. Okay. So what does it mean here? So they tell you in the question, salvage value could be sold at $95,000. The tax is 0.34. Salvage value is $95,000 still. But book value at year 5 is already depreciated to 0. So in the book value, there's no more value. So this is how you count. Okay? This will give you 62,700, which you'll get it on the final year. $625, not $628. Yes. We account each year depreciation. Yeah. All right. After tax salvage value, is only for final year. If you're only in the final year, you can sell it off. Okay. Then what are the other criteria that we're missing out here? After tax cost saving. Okay. Question told you after tax cost saving is $183,000. You need to minus off the taxes. 1 minus tax is 0.34. What do you get? 120,000. This one will give you 120,780. This is your cost saving. Okay, this is cost saving. And the last information that they give you is net working capital. Net working capital, very simple. Remember this, net working capital, that means initial investment, $41,000, right? Remember, for net working capital only, year 1, negative $41,000. At the final year, you will get back the net working capital, $41,000. Okay? So up until here. Up until here. Up until here, this is the figure. This is all the figures that you get up until here. Okay? So after this line, you can already get your OCF. Okay? OCF, your operating cash flow. Total up together, negative 625 minus plus for negative 41,000 means positive, negative, negative lah. So here you will get 666,000 for year 1 to year 4. Okay, Year 1, 2, 3, 4, the cash flow should be 163,280. And year 5, the final cash flow is 266,980. Okay. All right. So up until here, you already can count NPV actually now. Okay. But this capital budgeting, they give you another different method. PV factor at R equals to 8%. So the discounting factor is 8%. So very simple lah. This is the initial outflow, so you don't discount anything. So here is 1. You divide it by 1 only one. So it's the same value back. But because they want to make it shortcut from year 1 to year 4, you know, to repeat, it's the same cash flow. So the formula is the one that we do before, is 1 minus 1 over 1 plus R, power of T divided by R. Okay, this is the formula. I hope you guys remember. And then this last one is the final one, which is 1 divided by 1.08 power of 5, because it's year 5. Okay, this one replace to 0.08. So it's 1.08. The T is 4. So this will give you a PV factor of 3.3121. This will give you 0.6806. So to get the NPV, you need to get the PV first. So the PV, 666,000 times 1 is still negative 666,000. 163,280 times 3.3121, you get 540,800. 266,980 times 0.6806, you'll be 181,707. So net present value is the total of all these together. All right, so you should be getting 56507. So no need to use calculator for this, waste of time. Okay, so the question here is very confusing. Is where? Where's the confusing part? I will tell you. Students will be saying, what is this PV factor, sir? I don't understand. Why is this appearing here? Why do I want to use this? Okay, this is to make your life easier actually. So if you don't want to use this, what it means by, you're looking at the OCF here. You look at OCF, okay, very limited space. You look at the OCF. Look at OCF. Five years. 0, 1, 2, 3, 4, 5. Okay. This is year 0. Your initial investment, $666,000. Year 1, cash flow is 163,280. 163,280. 163,280. 163,280. Year 5 is 266,980. This is what it means. Okay? This is what it means. So, this 540,800 is basically the total of all this already. Okay? So, instead of taking one by one, the simplest method, because it's the same cash flow, you can use this 1 plus 1 over. So, basically, the formula you use here is this. It's a PMT times with 1 minus 1 plus R power of T divided by R. So they use this formula for this section. So straight away you get 540,800. Okay, then discount this one. So if you don't want this confusing, this is the confusing part only. This part itself, okay, this itself, it shows 3.3121. The PMT is 163,280. So times by 3.3121, you get this whole thing discounting factor. Okay, if you don't want to do this, you can do one by one. So basically, you got your OCF ready. It's simple. You got your OCF ready, you just do your NPV easily. You got, so basically it's negative 666,000 plus 163,280 divided by 1.08 power of 1, 1.08 power of 2, 1.08 power of 3, 1.08 power of 4, and 266,980, 1.08 power of 5. You get NPV. Okay? If you want to, if you think this is confusing, the PV factor section here, this is confusing. The moment you get your OCF, you can do already your NPV. All right. If you think this is confusing, you do this. You get the same answer. So the final answer that you should be getting is 56,507. So when you get a positive NPV, what happened? When NPV equals or more than 0, you accept this project. Okay? Ken. Ken cannot. Are you okay? This is very long questions, huh? Very, very long. Very, very long. Very troublesome also. Yep. Okay. Definitely you need to watch a few times on the video. Okay, it's very challenging, especially this section, to decipher one by one of the variables so you can fill into the forms.